In less than 48 hours, the Federal Reserve is going to cut by 25 basis points. Liz Warren's calling for a cut of 75 basis points. The market is starting to price in a cut of 50 basis points. Noise, 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 noise. We tune it out. We want to figure out how to put capital to work, how to make money, how to protect our assets, right? That's what we do here. So we're going to look at a few data points around the market, see what's going on at the consumer level, a couple of different sectors, where to hedge, where to take some chips off the table. Let's see what we can do. Start here, the weekly chart, how we closed last week. This is a Monday evening that I'm recording this, so a little bit, just a tiny little bit out of date. But the last time we had a thrust like this with a weekly performance as strong as this one we just had, look where we went afterwards. Will we get a repeat? So far, it's not quite shaping up that way, but a lot remains to be seen. This is a big, important week. The reversal on September 11th, never forget, would have been a disservice to this great nation if we didn't have such a mega reversal. And this is a crazy stat. Down 1.5% intraday to close up 1%. I believe the last time we did that was October of 2022. You may remember the rally that came after that. We're still in it. I mentioned that I think we're going to cut by 25. Well, the market disagrees with me. 69. Nice. 69% thinks we're going to see a 50 basis point cut. Let's see. I don't know. I don't think the Fed needs to be so aggressive here. I don't think it makes much of a difference. And in fact, it seems a little bit counterintuitive. If they cut by 25 and guide and say everything is fine, 25 basis points at a time is fine, I think that probably calms the market down. And it's more important what they do behind the scenes anyways. If they're creating backstops or if they're getting quantitative easing, they're getting liquidity into the system, come hell or high water, that's what's going to inflate asset prices. That's what's going to be good. So whether it's 25 or 50, I don't think it matters as much as keeping the markets calm. And that's why I'm calling for 25. And I think they'll do 25 again in November and 25 again in December. But let's see. The GOAT, our buddy Amit, great follow on Twitter. Let's just read it. I don't care if they go 25 or 50. I really don't. But I can't help but point out that right after inflation was 9%, with rates at zero, they went 25 basis points. First time they hiked. Where were all the Wall Street cheerleaders calling for 50 because real rates are too high? The asymmetry in their narrative is striking. Beautiful. I mean, what can you say? The hypocrisy. It's not just Wall Street. Liz Warren is calling for 75 basis point cuts, so God bless us all. From Apollo here, the proprietary research. This is a quote unquote fact sheet from Apollo. Just going through it. I mean, does this sound bearish? Restaurant bookings, strong. Air travel, strong. Daily debit card data, strong. Weekly data. GDP now, 2.5%. Fed's weekly GDP index, 2.3%. Retail sales, strong. Jobless claims sideways, so not increasing. Sideways. Flat is good. We like stability. Hotel occupancy, strong. Bank lending, growing. Bankruptcy filing, trending lower. Credit and debit card, solid. Global jet fuel, slightly weak, and you can see that reflected in oil prices, which are getting killed. But everything else looks good. I mean, come on. Who's bearish here? The year-to-date performance of assets. I saw something from Zero Hedge that I thought was interesting. I want to point this out, that the last time gold led in 2020, around 25% performance, was noteworthy at the time. I'm sure the doomsdayers were saying, what is gold telling us? And when the people do this line about what is gold telling us, they want to tell you that the world's about to end, the apocalypse is nigh. But actually, what gold was telling you in 2020 was that the monetary stimulus that is about to be flooding into the system is breathtaking. A monumental amount of money is about to be put into the system. And what happened next? Real estate did well, the S&P 500 did well, and commodities, a real proper inflation hedge, really went to the moon. And in 2023, eventually when that stimulus was absorbed into corporate earnings and onto the private sector's balance sheet, boom. So everyone who's saying that gold is up this year, and that's this big indication that the wheels are about to fall off, It might not necessarily mean that. It could just mean that stimulus is coming. And if stimulus is coming, you can kind of get a sense of how to position accordingly without becoming so risk off that you miss parts of the rally. So that is certainly something to keep in mind here. And speaking of gold, to be a little bit counterintuitive here, we're borrowing from our buddy. This is the long investor over on Twitter. Great investor. He puts out a lot of great content. His point with this one was anytime gold, if you look at his white circles, went below the 200 weekly moving average, that it was a brilliant time to accumulate. And this was painful because if you did it in 2015, 2016, 2017, 2018, even here again in 2022, you were, okay, granted, you were going up a little bit in this 5 year or so period, but from a compound annual growth rate perspective, you were getting killed. There are other assets that were outperforming. But the point is, if you're only accumulating at great spots to accumulate, do it underneath the 200 weekly moving average. With that point in mind, guess what is a flight to quality risk off that's under the 200 weekly moving average? The long bond, the TLT ETF. So is that the next one that's going to rip 10 or 20% and be the most obvious trade of all time? Maybe. But whatever happens next, there is always going to be a bull market somewhere. So let's stay focused. Switching gears here, this is just one data point. We don't make big decisions based off of one data point. Keep that in mind. Because I don't see a recession in the near term, not even necessarily in the medium term. We could, of course we could, but anything that says a 98% chance, take it with a grain of salt. All right. This is the market implied US recession probability by indicator. Recession starting in the next year. This is one that came out. You can't see on the bottom here, but this was from Haver Analytics. The 12-month forward implied change in federal funds rates. Okay, so the Federal Reserve is going to be bringing the Fed funds rate down aggressively, means there must be a recession. Based on the way it's priced currently, 98%. Two big takeaways here. One, okay, maybe we do go into recession. Two, maybe we're not bringing the Fed funds rate down as much as we think we are. I mean, we got the market calling for 50 basis points, Liz Warren calling for 75 basis points. Both presidential candidates, I'm sure, want to go back to zero rate policy. Maybe we're not going to go down there. All right, keep that in mind. Now, continuing on this idea of investment themes, why do we split hairs? Well, we don't. Not in the near term, but over the long term, we do. Why? Here's why. A 13% compound annual growth rate versus an 11.54% compound annual growth rate, both during the time frame of 56.69 years. One was Pepsi, one was Coca-Cola. You're building a portfolio. Hey, what's the difference between Pepsi and Coke? A simple enough question. Over the course of 50 years, all right, you got to zoom out. Depending how old you are, if you're my age, a young gentleman or lady, you got a lot of life ahead of you. You want to think about how to outperform by a few basis points. You don't want to split hairs per se, but 1.5% compounded long enough makes a hell of a lot of difference. We're talking about double in this case, being up 1,002, 567% versus being up less than 50,000%. Quite a return in both cases, but this is why you have to consider themes in your investment and how to outperform over the long haul. Important theme. Let's get the old head out of the way here. So when we talk about seasonality trends and how this next 2-week period is one of the weakest in markets, you can think about how this time is different, or that different technical factors are different, or different fundamental factors. You can do that. The point really should be that when you have an opportunity to take some risk off the table, to rebalance, reconstruct the portfolio, generally this is not a bad time to do it. All right, so I'm not going to spend a ton of time here, but look at 1 up move, 7 down on a 3% move. 1% moves, 6 up, 25 down. Okay, so there you go. The worst 10 days are now upon us, starting on September the 16th. You can trade against it if you want, but if you haven't put your hedges in place already, then keep it in mind for the future. You have to pay attention to data. This is a good chance to rebalance. You may have been able to put some insurance in place through either some put contracts to protect against downside. You could buy some volatility index longs in case volatility rises. A lot of things you could do to make some money and keep yourself protected and make sure that that compound annual growth rate remains where you want it to be. Another one here, this is more on the retail side of things and hard to measure how much impact something like this has. On the left is household equity in real estate. On the right is home equity lines of credit. Some people look at lines of credit and they want to give you the doomsday scenario. Oh, they need credit now. They're borrowing money. It's going to cause a problem in the system. I'm not taking that approach. I see equity increasing on the left side. I see people tapping into it on the right side. It's not a bad thing. In fact, this is even prudent if the value in your home is increasing and you know that rates are going to come down, which they are, and it may give you an opportunity to refinance. Yeah, spend a little bit of cash right now. Put some money into the system. Not a bad thing, at least not in a vacuum. I had to bring this up because this is another one that in isolation, you see something like this. Yeah, you have a bit of a think. Okay, what does this mean? Some of us are very partial to remote work. We prefer it. Your company is watching you and probably doing it all wrong. Employers often feel like they have to keep an eye on their workers, especially those working remotely. There are bad ways to do it and not as bad ways. Okay? I'm not going to read the whole article, at least not right now. Some people have this feeling that the bosses are trying to catch you in the act of doing something. Some people feel like it's unfair. Don't they have better things to do? It's this whole back and forth. And another group or another demographic looks at this and says, because their balance sheets are poor and they need to get rid of employees, they're going to start reading into your messages, and that's how they're going to get rid of you. I'm, you know, I'm not opposed to going down the rabbit hole and getting conspiratorial. I don't think that this is what this is. I'm sure if you're not performing adequately, they probably could find a reason to get rid of you. They probably would have built that into the contract instead of trying to find a message you wrote saying that he has bad taste in shoes or something. But, one way or the other, I do think that this is an interesting point. I'd be curious what other people think about this. If you're not being productive, that's what you should be worrying about. You know, I'm just going to leave it at that here. Another one, I saw this and I really like this. This is a totally big switch of gears, but if you guys saw this, and you should check it out. It's very, very fascinating, very interesting, compelling stuff. Mr. Beast put out this manifesto type of document about how to succeed within his team, either joining as a staff or being in one of the videos. And he had incredible insight. It's always insightful when you hear from someone who's a magnificent success in their industry. One thing he talks about is the use of consultants. I don't know when this happened. It was relatively recent. At some point, consultants just started to get a bad rap. Let's just hear it from Mr. Beast. Literally cheat codes. Consultants are literally cheat codes. Need to make the world's largest slice of cake? Start off by calling the person who made the previous world's largest slice of cake. LOL. And it is kind of funny. He's already done countless tests and can save you weeks worth of work. I really want to drill this point home because I'm a massive believer in consultants. Because I've spent almost a decade of my life hyper obsessing over YouTube, I can show a brand new creator how to go from 100 subscribers to 10,000 in a month. And it goes on and on. If you're a business owner, if you're an entrepreneur, if you're trying to get from this one threshold to blast that ceiling over and get to that next level, there's no shame in working with management consultants. Just hire a good one, like a family office like we run, where we're nimble, we're agile, We know a thing or two about a thing or two. Okay, and as we usually do in these videos, we'll go through what's going on in the world of private opportunity, private equity, alternative investments, different asset classes. I still like Bitcoin. Bitcoin it struggles in September, then performs phenomenally well from October through March. We made a video about it. There are good opportunities in certain emerging markets and developed markets. I still like precious metals. I am starting to really like the energy sector. I really absolutely love these electrical energy utility infrastructure plays for the decade. So I'm not going to rehash a lot of stuff I've already said. Let's just go through the headlines because these headlines paint a great picture, and that picture is giving one clear message. There's opportunity out there. There is deal flow out there. There are extremely compelling stories that are for sale at attractive valuations, and entrepreneurs are going to make money. Good owner operators are going to make money. That's just what they do. Particularly as the narrative shifts, people start to get a little bit more fearful. Opportunity is coming, and preparations are already in place. Let's go through some headlines, and I'll show you a little bit of what I'm seeing out there. This is stuff you can do too. If you want to get underneath the hood, as always, do please get in contact with me. We have some proprietary research that I would love to share with you. But just the for free stuff on the internet, funds you've never heard of, raising $750 million, private credit fundraising, to decline for the third straight year. But it sounds like opportunity to me with rates about to come down. What else? Oh, a nice advertisement. I don't know what that is. Dwells on taxes at the UK summit. Okay, fine. Oh, their taxes. By the way, for the folks in the US, you're worried about Kamala raising taxes. We're still not Europe, so be thankful. What else? Apollo goes after Wall Street's core. I don't even know what that means, but jostling to sell alternative assets to wealthy investors. Of course, because wealthy people want to buy alternatives. Of course, you'd want to sell great products to people who can pay a premium. Apollo pushes into high-grade debt, long dominated by banks. I like this one. I like the title of that article because you know what it used to say is that private credit is infringing on the turf of the banks. So now it's like, oh, it's not a turf war so much. It's almost like a level playing field. Oh, interesting. 600 million for a fund here. KKR $13.5 billion breakup. That's interesting. I might have to save that and read that one later. Buyout executives exit slowdown. Okay. Restructuring and a spinoff. Frankfurt IPO. Okay, I saw this one in Frankfurt. That's Germany, I believe. There was another one in India today that I think was one of the largest IPOs. Global IPOs could be back on the table. What else is going on? Wall Street Journal here. Private equity backed companies market revival brewing. Private credit fundraising on track to decline for Thursday. Okay, saw that one. Create zinc shares record high. Interesting. Commodities. What is there? I don't know. Whatever. What else? 16 billion freight deal humbles private equity. This was an interesting one because the takeover given DSV a huge boost. That's sore for runner-up CVC, but it's also amazing. Private equity even came close. So private equity nearly beat a bank for a serious buyout deal or a merger and acquisition. Interesting. And okay, here you go. So everything else is just headline stuff. Here's a number that is actually meaningful. $722 billion war chest in the hunt for deals. Okay, you think there's going to be deal flow? If money is being prepared, there's going to be deal flow. That's just how it works. I don't make the rules. What else is going on? In the world of alternatives, I saw an interesting one here. Distressed investing. I'm sure that's going to come back here. Skin in the sports investing game. Yeah, fine. Gold edges down. Okay, this was one. Crypto could become a standard sleeve in diversified portfolios. I'm not sure if I would use the word crypto. I would say holding some Bitcoin offline in cold storage, never a bad idea. Cold storage being a key point there. Don't hold it on Coinbase. Don't buy the IBIT, BlackRock, whatever that is. I don't even know what that is. A Bitcoin ETF. Just hold the Bitcoin. You're gonna need it when the capital controls go into place for a zombie apocalypse. You'd rather have the Bitcoin on a ledger. You could flee the country and still have it. Don't you want to have that freedom? Isn't that the hedge that you want? But the fact that these are even mainstream narratives at this point, that's progress. Okay. And the last point here, I started to get into a little bit of a rant about this a moment ago about AI, data centers, electric vehicles, renewable energy. This is Lance Roberts and the guys over at Real Investment Advice. They're getting into the point about the power grid and the electrical system. We're not going to go through this whole thing, but the point here is simple. AI, data centers, the power grid, electric vehicles, we need more energy. If we're going to consume more energy, we need to produce more energy. And how are we going to do it? Here's the charts. EV sales going through the roof. This is the parabolic advance. And you got to think about, what does this mean for the consumption of the electricity? AI data centers, this whole AI revolution, NVIDIA. If NVIDIA is going to become a $10 trillion company, then think about the data centers that are going to need to be there proportionately to get you to that point. And it keeps going. Bitcoin mining, another one. Imagine if Bitcoin is going to become a strategic reserve asset. You got to mine the darn thing. Okay, the EVs, the US households, charging phones, data centers for something like Google for its for the cloud. Then there's natural gas, and then here's where it starts to get a little bit crazy. You need all this much energy. US natural gas is one of its primary producers. The cost of natural gas is about as cheap as it's ever been. We're starting to see some risk reward scenarios here that are starting to make a lot of sense. What else do we got? The upstream producers. So you can get into some ETFs or some mutual funds that give you exposure to the producers or to the explorers, as well as downstream, midstream, and upstream. So you can get a exposure to the whole process, and they'll pay you a dividend, and your share price is likely to appreciate too. I think there's really good stuff there. So it goes into the different phases of the stream. Natural gas, it has this whole thesis about nuclear energy versus other power sources. Uranium, another one, and the price of uranium starting to get a little bit attractive again. The uranium miners can be interesting. Nuclear power, not a bad way to do it. And I'm just skimming here just to give you guys a little bit of inspiration to go and have a read of an article like this for yourselves. But my goodness, what a theme for the next several years. And we looked at Pepsi and Coca-Cola to give you a sense of if you buy and hold something for 10 or 20, 30, 40, 50 years. So imagine you're about my age. You're a young person. You got 40, 50 years of life ahead of you. You don't want to necessarily take the risk of getting into something like Bitcoin or stock picking something like Tesla. Although I could make extremely bullish cases for those assets. If you wanted to take some risk off and you still wanted to have a great compound annual growth rate, getting exposed to energy producers, and not just the energy, don't restrict yourself just to oil and gas like Exxon and Chevron. No, get involved in this whole phase. Choose a diversified fund that is going to be involved in all of these different aspects, all of these different commodities, the refining of all these different materials, and the exploration, the production, the refining, the transportation, the logistics, all of it, downstream, midstream, upstream. There's good opportunities, all right, to be tame with my assessment. Very good opportunities in that space, and I would recommend checking out Real Investment Advice, this part 1, 2, and 3 about the power grid to do some of your own research. Alrighty, folks, take care.